The past few years have been a fascinating case study in investor behavior. Sentiment surveys, headlines, and investor commentary have often projected caution, yet capital flows and portfolio positioning have told a far more constructive story. In a market where actions and narratives increasingly diverse, is the smarter framework to stop asking investors what they believe and start studying what they own?
Yeah, I mean, I think in general, the last 6 years have been a very strong lesson in humility. We have, obviously, I grew up on the PM and research side of this business. I spent 15 years doing that, and my belief at that point was, if you just know more about the company than everybody else, you're going to win. And diving deep into financials and competitive positioning, things like that. What the last 6 years have taught us is blind loyalty to a model or without the ability to be flexible is dangerous. So you think about, since COVID broke everybody's brain, what have we observed? Well, number one, retail investors have actually been less emotional in a lot of these sell-offs and movement in and out than institutional investors have. The retail investor is getting a lot of sarcastic responses these days about perhaps being over levered in the semi space, and there's some elements of that for sure. But if you look at the last 12 months, fund and ETF flow data, 1.1 trillion into equities, $1.0 trillion into fixed income, $1.2 trillion into money market account. That does not feel to me like irresponsible over levering into a certain market. Meanwhile, the institutional investors have been all over the place. They're used to being able to scare retail investors out of the market. And right around 2022, a lot of interesting things happened with that. Specifically, retail investors stopped playing ball. They stopped panicking into sell-offs. Used to be hedge fund sell, then long only sells, then retail investors panic. The last dollar out on retail gets handed back to the hedge fund who's now buying back in. That stopped working. We saw it on Wall Street Bets, and we've seen it very consistently since then. We've also seen the bond market in a lot of ways act more, at least on the rate side of things, act more emotionally than the equity market. And that's something we're not used to seeing. We always see the bond market as the adult in the room. That really hasn't been the case, at least in terms of being in and out very rapidly. And then perhaps most interestingly, observation-based analysis has worked better than pure quantitative modeling. And that is something that all of us have a very difficult time to come to terms with. But if we continue to follow survey-based data as if it's a religion, we're going to continue to get whipsawed. And that has been the big learning over the last couple of years. People just either don't answer surveys or they don't answer them as honestly as they used to. It used to be an almost perfect, whether it was leading indicators, whether it was all of these consolidations of opinion-based research used to be the most important teller of future activity. That's no longer the case. You look back at 2022, for example, the institutions got completely on the sideline. The retail investors were the one buying back in. At that point, economists had a 77% chance of a recession built in. The strategists coming into 2023 had a 4% expectation for 2024. Well, they were off by 20%. So we collectively, as a professional investor / expert base, were way too conservative then. Happened again in Liberation Day, and certainly happened again earlier this year, where the retail investor is basically blindly throwing money at the market every 2 weeks, and then in any significant period of sell-offs, last 12 months, for example, the big down days saw 3.5 times as much buying from retail investors as every other day. That's, you would say, fairly rational behavior, and it's worked. And the more that it works, the more that the self-fulfilling prophecy starts to work. So in my opinion, watch what people are doing, not what they're saying. Whether that's investment, investor sentiment right now is lousy, relative to the market, almost at a record high. You have, consumer confidence at consumer sentiment at almost record lows, where people are still buying everything they can buy. So watch what people are doing, because survey-based analysis is, especially if you're wed to it, because we've all spent a lot of time and money creating these models, and we don't want to give them up. But if they're not efficacious anymore because people's brains have changed over the last 6 years, we at least need to watch what's happening versus what is supposed to be happening.